So this beautiful accounting equation we learned in chapter 1. This is never going to change. This is going to be on this whiteboard every day that we have class this semester. Sometimes I may even call on you to come up and write it, just for fun, if I'm feeling frisky. Because it is the foundation of everything that we are doing in this class. It is the way that we identify, record, and communicate information about a business, is through this accounting equation, okay? So in chapter 2, what you're going to learn is going to be somewhat of a review of this accounting equation. We're going to dive a little bit deeper into some assets that we maybe didn't talk about very much in chapter 1. Some liabilities that we didn't talk about in chapter 1. Reiterate the parts of equity that we did talk about in chapter 1, okay? So some of what we do is going to be a review. And then you can see here in our learning objectives, then you're going to learn about the actual accounting system that businesses use in order to account for all of their transactions. That Excel spreadsheet that we were using in chapter 1, the one that we used in class, the one that you used for your quiz, where it had the accounting equation at the top, right? And we analyzed our transactions and put them in the right columns. That's not what accountants use. Accountants don't use that as a system to identify, record, and communicate their accounting information. They don't use that template that we're using in our class. That's just for educational purposes, okay? We are going to learn in this class, what does the actual system of accounting look like that businesses use to keep track of all of their business transactions? You are going to learn about the accounting system. In addition to reiterating what we learned about the accounting equation, you're going to learn about the accounting system. And that's where this concept of debits and credits are going to come into play. Okay? That probably sounds like a foreign word to you right now, or 2 foreign words to you right now, if you haven't had an accounting class, right? And even if you have heard of those words, I would bet that the context that we're going to talk about in this class is going to be a little bit different than what you might have in your mind about what they mean, debits and credits. But debits and credits is what we are going to use in our accounting system. So you're going to learn about that process here in chapter 2, okay? But again, I just want to be as clear as I can. Chapter 1, where we learn about this accounting equation, this is where it's at, man. This is where it's at. This is everything that we're going to do from here on out. If you can understand the accounting equation and you can ask yourself those questions, when you read a transaction, if you can ask yourself, what account names am I going to use, right? And again, you can use that list that I gave you in chapter 1. What account names am I going to use? 2, for each of those account names, where do they belong? Is it an asset, a liability, or one of the 4 parts of equity? And 3, is it increasing or decreasing? If you can do that, this next step that we talk about here in chapter 2, piece of cake. Cool? Everybody with me? So we're just going to plug away at chapter 2. Maybe we'll get out a few minutes early if everybody's engaged and participating and answering my questions and looking at me with smiles. I like it. Thanks, Josh. So here we go. We have, again, this process that we have to work through. It starts with the transaction actually happening, and it ends with us preparing those financial statements, right? At the end of chapter 1, we got introduced to the financial statements. There are 4 financial statements that companies must create. They're required to by law at the end of every one of their accounting periods, okay? The income statement. And the income statement is going to take all of our revenues. So I'm going to put IS and expenses. IS, because those go on the income statement. And that income statement is going to calculate for us, what? Do you remember what was down here when we did this on, what day is it, Fred? When we did this on Wednesday? Revenues minus expenses, Jordan. Net income. I'll even spell it out today. Net income. That's the first statement. The second statement is the statement of retained earnings. You guys are going to get to know how big of a nerd I am, how excited I get when I get to color code things. It's my fave. The statement of retained earnings. And the statement of retained earnings is where we take our net income and we subtract out our dividends, right? Retained earnings, the earnings that you keep. So here are our earnings, that's our income, right? Earnings and income we can use sort of interchangeably as terms. Here are our earnings, and what do dividends represent? What is a dividend? Right, so we give out some of our income, some of the profit that we earn to our investors. Thank you so much for being investors in our company. Here are some of the profits. Here's some of the income that we've earned this period. Trace. Net income minus dividends. Net income minus dividends. Okay, that's the second statement. And then after that, let's see if I have another color. It's just black, but that's okay. Then after that, we create the balance sheet. And the balance sheet is going to list all of our assets. Probably shouldn't have BS on the board, right? Guess I'll have to spell that one out. Balance sheet. Better. All of our assets. All of our liabilities. And a summary of equity, right? A summary. Because we already put revenues and expenses on the income statement. You only put it on one statement. Each element that we talk about in this equation only goes on one, okay? We already put revenues and expenses on the income statement, and we already put dividends on the statement of retained earnings. So our summary of equity is going to be common stock is going to go on the balance sheet in the summary of equity, and whatever we come up with here in retained earnings is going to go on the balance sheet. Make sense? Sometimes in previous class, I'm not telling you you have to do this. Sometimes in previous classes, when I would do this, people would take pictures of it. I don't mind you doing that. Keep me out of the photo. But I don't mind you doing that. If this is something that makes sense to you, use it every day. Write it down next to you. Every time you go to do your homework, write this down. Have it open in front of you, okay? I went off on a real big tangent there. But what I was getting at is that there is a process. The company has a bunch of transactions, and then they have to make these financial statements, right? And by the way, there's a fourth statement. Do you remember what the fourth one was called? Statement of cash flows. Who said it? Trace. Statement of cash flows. And I told you, we're going to talk about that one later in the semester. We're going to go through a chapter where we look at it and see what it tells us. What's its purpose? What's the format of it look like? But you're not going to actually have to make one. These three, you're going to have to make it. Okay. So we have this process. The transactions occur, and then we have to make financial statements. What has to happen in between those two bookends where the transactions have happened and we make financial statements? There has to be steps in between to get us to the point where we can make the financial statements. Okay. That's what this chapter is going to walk us through. Okay. Notice the first step is identify the transaction and event. We were already doing that in chapter 1, right? Now, in the bubble of this classroom, the way that we identify a transaction is we read it in the problem that's given to us, right? It's not that easy in the accounting profession, right? When you are out working for a business in their accounting department, you're not just given a list, oh, here's all the transactions that happened today, right? Not necessarily, sometimes, not necessarily. You have to identify transactions from what we call source documents. So what is a source document? A source document is some type of evidence, okay, that triggers the transaction occurring. For instance, a bill comes in from a supplier. If a bill comes in from a supplier, that means that we bought something and we owe them money. There's a transaction that needs to be put in our accounting system. Are you with me? We bought something We haven't paid for it yet. We have to put that in our accounting system. Sales receipts, right? If we have a log of our landscaping company, right? We're mowing lawns all day long. We have a log of all the work that we're doing, and we send that to our customer to say, here's all the work that we did. Here is what you owe us, right? That is a source document that shows that we have revenue. We've earned revenue. Any checks that we write or checks that we receive or wire transfer documentation that shows that we've either paid cash to someone or received cash from someone serves as a source document, okay? So in the real world of accounting, we have to have evidence that the transaction actually happened, right? This is the kind of evidence that we're talking about. In the bubble of this classroom, you're not going to be given a bill from a supplier and asked to create a transaction in your accounting system. You're going to be given a list, a bulleted list of everything that happened that month, and that's how you're going to identify that the transaction happened. Does that make sense? So the identification is a lot easier in the bubble of this classroom. You're going to be given a list of transactions that happened over the given period of time. But that's where the process starts, right? You have to know that, yes, something happened, and that something is going to have an effect on our accounting records. That's the first step. Are you with me? And we talked about that in chapter 1. The second step, we also talked about in chapter 1. So again, I mentioned to you that chapter 2, some of it is repeat, right? We're reinforcing the things that we learned in chapter 1. In chapter 2, we also said, okay, once we know that, sorry, that was bubbling up for a couple minutes. Once we know that an event has occurred, right? We have to analyze that event in terms of our accounting equation. That's where our 3 questions came into play, right? We know that this activity happened. This transaction, this event has actually occurred. Now we have to know what accounts are going to be affected by that transaction. And again, we can use the list that we accumulated in chapter 1 in our spreadsheet. There was a list of account names that you could go back to, right? 2, we have to know for each of those accounts that we're identified, where do they fit? Is it an asset, a liability, or part of equity? And 3, is it increasing or decreasing? Okay. So to help us get used to some of the account names, we've talked about a lot of them already in our chapter 1 examples. But to help us get used to some of those account names, we are going to walk through, okay, what each individual part of our accounting equation is going to include, okay? Now, this is not going to be an exhaustive list of every account name that you would possibly see as an accountant. But this is going to be an exhaustive list of everything that you will see in this class. Are you with me? There are obviously going to be more complicated accounts that accountants have to deal with that you'll learn about in intermediate accounting or advanced accounting if you decide to sort of move forward with the accounting program. But what we talk about here is going to be a more exhaustive list of the accounts that we're going to be discussing and that you're going to be expected to know about in this class, okay? So an account is going to be a record of increases and decreases in a specific asset, liability, or one of the components of equity. And if you accumulate all of those accounts together, we call that a general ledger. Again, some of this is brand spanking new, like a foreign language, right? These are terms that you have not used in your everyday life, at least in this context. So we want to sort of understand what these terms mean. An account is just a record of the increases and decreases of one specific thing. But a general ledger is an accumulation of all of those put together, okay? So think of it, I'm a very visual person. So I think of it as, okay, there is a file folder or there is a drawer that has all the assets in it. Each asset has its own folder in the drawer. Are you with me? And in each asset's folder is a record of all of the increases and decreases to those assets. But the assets are all housed in one drawer, right? And then we have a liability drawer. Open up that liability drawer. There's a folder for each individual kind of liability that we have. And in each folder, right, is documentation or evidence of the increases and decreases to that specific liability. And then same with equity, right? Equity, each individual element of equity has its own folder. It's all in the same drawer, but then they have their own folder where we keep the details. So if we look at all three of those drawers together, that's our general ledger. We're looking at every account that is included in our accounting equation and accumulating all of that information into one place. That's called the general ledger. Okay? And we'll walk through, obviously, this is, again, just a visual for educational purposes. This isn't the way that we account for things. I'm going to show you what that, we probably actually won't even get to that today. We'll probably get to that on Monday, but I'm going to show you how do we accumulate all of that detailed information. If each asset has its own folder and every folder has a bunch of details in it, how do we group it all together to see sort of what the big picture is? That's what we're going to get to probably on Monday. Okay? So let's talk first about our assets. As I mentioned, we have already discussed the majority of these assets in our chapter 1 examples, right? We already discussed cash, right? Cash is what we receive from our customers when we perform a service or provide a product. It's what we use to pay off our suppliers when we owe money to people or pay off a loan that we've taken out. Cash, right? We're used to that. I'm going to go, I'm going to go counterclockwise. Land. We own a piece of property, right? That is an asset. We own it and we're going to benefit from having it. We're going to pave it and make a parking lot. We're going to put a new building on. We're going to sell it to somebody else, right? Either way, we own it and we get to benefit from having it. Land. Buildings, right? Hiram owns East Hall and benefits from having it because you all get to live here and I get to teach in here, right? I get to help Hiram generate revenue, tuition revenue, by teaching in here, okay? Buildings. Equipment. So you can think of equipment also sort of as a general blanket category that can include machines that a company might use in like a manufacturing process, right? We manufacture our water bottles. We have to have machinery and equipment in order to take the raw plastic and turn it into a water bottle, right? Machinery and equipment. But equipment may also include things like automobiles, right? Equipment may also include things like computer systems. Typically a general category. Oftentimes if we use, like if we say, oh, the company purchased computer equipment or computer software, I'll just use those terms. But equipment is sort of like a blanket category for those kinds of assets. Make sense? Again, we own them all. We benefit from having them. Supplies. What is the difference between supplies and equipment? Yeah, Caleb. Okay, absolutely. How not so multi-use in the sense that a piece of machinery we may use for a particular product and then we can move it and go use it someplace else in our facility, right? Multiple uses. But also the time period that we plan to use a machine versus supplies. Machines, land, buildings, automobiles, computers, desks, chairs are all examples of what we're going to call long-term assets. They're assets. We own them and we're going to benefit from having them. But we are going to use them for more than 1 year. Long-term assets. Are you with me? Did we talk about this already? Long-term? Short-term? Okay, I didn't think so. I have auditing right before this class, and sometimes I get confused with what I said. Long-term assets. Supplies. Cash. Accounts receivable. Prepaid accounts. I know we haven't talked about it yet, but those are all going to be categorized as current assets. So if long-term assets mean we're going to use them for more than 1 year, current assets, we expect to use up those assets within a 12-month period, right? So the paper in our printers isn't going to last us for 5 years. We're probably going to use that up in the next 2 months, and we're going to have to order more, right? Kayla. Current. It is the most current, right? Because cash is the thing that helps us do all the other stuff. Cash is the thing that helps us buy the equipment and buy the supplies, right? Pay off our loans. Cash is current. So on this list, if you want to sort of label them, land, buildings, equipment, and notes receivable are long-term. Accounts receivable, cash, supplies, and prepaid accounts, short-term. Current. Notes receivable over there on the right-hand side. We haven't talked about it yet. I'm getting to it. Notes receivable. All things that we can own and benefit from having, but it's just how quickly are we going to benefit from having it, right? Is it for a long period of time, or are we going to benefit from having it real fast because we're going to use it up? Okay, so supplies. Again, things like ink in the printer, paper, pencils, other supplies that the office staff would use. Gasoline in our landscaping business. Right, all supplies. Okay, now, prepaid accounts. I mentioned this very briefly, I think, in our chapter 1 lecture. Let's say that on September 1st, we were required to make our rent payment. We're renting an office space for our landscaping company, okay? On September 1st is when our rent payment is due, September 1st. But our payment is covering the month of September. Are you with me? We make the payment on September 1st, and it's covering a future period of rent. That is going to be called prepaid rent. Okay, that's an asset because we own it, we paid for it, and we're going to benefit from it. We get to use that office space for the whole month of September. We pay for it on day 1, and we get to use it for the whole month of September. Prepaid rent. Are you with me? As opposed to, we pay rent on August. How many days of the month are in August? 31, 30, 31. We pay rent on August 31st, and it was paying for the month of August that we already used. Are you with me? We pay rent on August 31st for the month of August. So we've already been in that office space for the entire month. That is rent expense. That goes under the expense column. Okay. So if you are paying for something and you're going to utilize it in the future, that is prepaid. So you're going to see in some of our examples, prepaid rent, prepaid insurance. Those are the more common ones that you'll see in our examples. Trace? Okay, let me finish it and let me know if you still have a question, okay? So you pay for something in advance of actually using it up. That's a prepaid account. If you are paying for something that you already used, advertising was one of the ones in our example that we went through in class. The newspaper already printed the ad, and now you're paying for it. You're not getting new advertisement next month. You already got the advertising. That is an expense. When you've already used it, it's an expense. When you're going to use it in the future, it's an asset, prepaid. Why am I talking so slowly and harping on this so loudly? Because this is one of the most common mistakes that students make. You have to think about the time frame, right? When the cash trades hands, when you actually make the payment is important. But then you have to think to yourself, okay, yes, I paid for this thing, but am I paying for something that I've already used? If so, expense. Or am I paying for something that I'm going to use in the future? If so, asset, prepaid.
I'm not sure I understand.
She doesn't understand. Do you understand? You got it? Okay. Everybody cool on that? Okay. I'm going to skip notes receivable because I want to talk about accounts receivable because that's one we're familiar with. And then the notes receivable is going to make way more sense. Account receivable. What did we say in chapter 1 that we use? And PS, bring up that Excel spreadsheet that you used in chapter 1 to answer my question right now. That's not cheating. We're in class. Okay. What do we use account receivable for? What does it represent? What has to happen for us to show account receivable on our records? Cooper. Say it again. We already performed the work. They owe us money, right? We are billing a customer for work that we already did. Account receivable. Keep that in your mind, right? Use context clues with some of these. Receivable. We're going to get money in our pocket. We're going to receive money in the future. So we use account receivable to represent money that a customer owes us. We already did the work. We get to show revenue on our accounting records. But then the other side of it is they owe us money. We use account receivable. Are you with me? Note receivable is the exact same scenario, except we give that customer a little bit longer of a period of time to pay us. So instead of saying, normally terms would be like you have to pay within 15 days, within 30 days, something like that is what you're going to see in our transaction analysis. Okay. So if we decide we want to give them 6 months to actually pay us, we would have them sign a contract. That's number 2 difference between a note receivable and account receivable. Number 1, we're going to give them a longer period of time to pay us what they owe. Number 2, we're going to make them sign a contract so that we are on the same page. You know what you owe us. You know when you're promising to pay us. You know what services this is paying for. Everybody's on the same page. We make them sign a contract. And number 3, are we going to give them 6 months to pay us just out of the kindness of our hearts? Cutthroat business, baby. We're going to charge them interest, right? That typically is the 3rd difference between an account receivable and a note receivable. We charge them interest. So we perform our landscaping services $1,000. And we tell that customer, 1, you can pay us in 6 months. Forget 30 days. You can have 6 months. We have a good relationship. Fine. You need a little extra time. But 2, we're going to make you sign a contract. And in that contract 3, not only is it going to specify that you owe us $1,000, it's also going to quote, for goodness sake, it's also going to quote an interest rate. Siri. It's also going to quote an interest rate. In addition to paying us $1,000, you're going to pay us 5% on top of that. So you would owe us $1,050 at the end of 6 months. Are you with me? So an account receivable and a note receivable at their foundation mean the exact same thing. A customer owes you money. But with a note receivable, we're going to give them a longer time to pay us. We're going to make them sign a contract. And because we're giving them a longer time to pay us, we're going to charge them interest. Are you with me? We will not get into the accounting for a note receivable until like chapter 6 and 7. Okay. But just so you're familiar with the terminology. All right. So that's all of them, right? Any questions on these assets? Again, that's a pretty exhaustive list of the types of assets that you're going to see. One thing, obviously, you want to make note of is that for prepaid accounts, they'll be specifically named, like it'll be prepaid rent or prepaid insurance, right? But if it says prepaid, you are going to go, ding, that's an asset. Kayla.
This is back to the
Yes. Because that's a very good question. So a note receivable, I am going to retract what I said about note receivable and say that a note receivable can actually be both current or long-term. Because we could say, okay, we're going to give you 6 months to pay us. That would be current. But what if we give them 2 years to pay us? That's long-term, right? The cutoff between long-term and current is 1 year. If you're going to use up that asset, if you're going to get cash from that asset within 1 year, it's current. So a 6-month note receivable would be a current asset. A 2-year note receivable would be a long-term asset, more than 1 year before we're actually going to see cash from that customer. Good question, Kayla. I don't mind admitting when I'm wrong. I don't mind retracting statements and rephrasing things when I said something that didn't make sense. Please call me on it. Are you about to call me on it? Go ahead. Yep. Any other questions about assets? Liabilities. Let's take a 5-minute break. I feel like it's super hot in here. I actually need to get out and get some air, to be honest. I'm feeling a little yucky. So let's take a 5-minute break and then we'll come back and pick up with the liabilities conversation, okay? Okay. Just as the case was with the asset slide, you're going to be familiar with some of what we talk about on the liability side, right? So we said liabilities are any time that we owe to another party. So when we buy everyday purchases, right, things like supplies, eventually when we're talking about like a retail store where they have to buy inventory to put on their shelves, anytime we're doing those sort of everyday mundane purchases, we use account payable. That's the general liability account name that we will use when we're doing those sort of everyday types of purchases. But then we could set up other liability accounts. Here you see they're called accrued liabilities, but I mentioned to you that we're going to use the word payable. Okay, so let's say, for instance, our employees have worked for us for the entire month of August. Okay, so at the end of August, we owe them money, but their paychecks are not going to come until September. Okay, at the end of August, we owe them money. We're going to call that salaries payable, right? If we get Trace. So remember double entry accounting? I'm really glad you brought this up. Double entry accounting says that every time you have a transaction, there's going to be 2 effects to it, right? At least 2 accounts are going to be affected. In the scenario that I just gave you, one account that would be affected is salaries payable. It's a liability and it's going up. The other account that would be affected is salaries expense, because we have incurred the expense of those employees working for us. And so the other part of our accounting analysis would be salaries expense. It's an expense and it has a negative impact on equity, right? So every transaction that we're talking about is going to have two parts to it, at least 2 parts to it. So the liability part of it is showing I owe money to someone. The expense part of it is showing I have incurred this expense over a period of time to help me run my business. Does that make sense? Because you can have an expense without a liability. What if we pay those people right on August 31st? Cash would be one account and salaries expense would be the other. You see what I'm saying? Very, very good question. Everybody understand my answer to that? So the liability part of it is I owe money to someone. The expense part of it is going to be I have incurred this thing, whatever it is, salaries, rent, utilities, all of these different expenses that I have to incur in order to run my business. That's what the expense side of it is. It's just whether we owe money to them or not. Did we pay them or do we still owe money? That's what the liability side is. Okay. So again, account payable is that general account name that we would use to include money that we owe for sort of everyday type purchases. And then we can have other payables that we would call accrued liabilities, or I will probably just call them other payables. Salaries payable, utilities payable, rent payable, right? Where we have something, but we haven't paid for it yet. And we could specify what that something represents. It represents salaries that we owe to the individual employees. It represents utilities that we have to pay to keep the lights and the gas and the water running, right? So other accrued liabilities. I'm going to jump over here to notes payable before we talk about unearned revenue. Notes payable. Remember the account receivable, note receivable conversation that we just had 5 minutes ago? Same deal. Account payable is when you owe money to a third party. A note payable is also when you owe money to another party. But what are those 3 things that we just talked about with the receivable? Trace, what's one of them? Interest. In this situation, though, we're being charged interest. We're not telling our customer to pay us interest. We have to pay the interest on money that we owe, right? Cooper, you had your hand up. What were you going to say? There's going to be a contract. So whoever we owe money to, they're going to make us sign a contract so that we all understand what's the, what time period do we have to pay? How much is it? What's the interest rate going to be? Right? And then what was the third thing? Why were we being charged? Why is there interest involved, Tim? A longer period of time. And again, to Kayla's point from the last slide, a note payable can be either current or long-term, right? If we have to pay within 6 months, that's current. If that note payable is not due for 5 years, that's long-term. Are you with me? So account payable and note payable, we owe money to someone in both circumstances. But in the note payable, they're going to give us a longer period of time to pay what we owe. They're going to make us sign a contract, and they're not doing it out of the kindness of their hearts. They're going to charge us interest. Cool? Any questions on those so far? So account payable, we have these other payables that you'll see kind of pop up with more specific names related to sort of what are they designated for. Note payable, now this guy, unearned revenue. It is the only liability that you will be presented with in this class that doesn't have payable in the name. It doesn't have payable in the name. Sometimes, by the way, when you do the Connect homework, right, in the book, they will use payable or they will say accrued. So I say salaries payable. Sometimes the book will say accrued salaries. It means the exact same thing. So salaries payable, accrued salaries, or utilities payable, accrued utilities. Exact same thing. But to be consistent, I always use payable just to not cause any confusion. But sometimes you may see that in the text. Back to my original point. Unearned revenue is going to be the only liability that you see in this class that doesn't have payable or accrued in the name. Unearned revenue. We are performing our landscaping services, right? That's our company. And a customer gives us $1,000 on September 1st. And that $1,000 is to pay for landscaping services for the month of September. Our customer just gave us $1,000. Did we earn that $1,000 as revenue? No, we did not. That's why it's called unearned revenue. Unearned revenue, right? It is money, cash, that we have in our pockets, and we have not done a thing to earn it. Nothing. Over time, we have to mow the lawn, right? And so over time, what will happen is unearned revenue will decrease, and we'll actually be able to show revenue because we cut the grass, right? But on the day that you get the cash in your pocket, if you have not done anything to earn that cash, that is unearned revenue. That's a liability. You owe somebody something. You either have to cut the grass or give them their money back, right? In other circumstances, we typically think about liabilities that you owe money to someone. With unearned revenue, it can either be money, you're going to give them their money back, or you just perform the service that you said you were going to do. Tim, I think you had your hand up. Did you have a question? Okay. I love them. Unearned revenue. It is the only liability that you are going to see in this class that doesn't have payable or accrued in the name. And it represents money that you have in your pocket that you have not done a darn thing to earn. You got no business having that money in your pocket. So you have to show a liability on your accounting records. I owe landscaping services to that customer because they gave me the money early. Are you with me? Trace. If we get cash, that's cash is an asset, and it's increasing, right? If we get cash and we didn't earn it, unearned revenue is a liability and it's increasing, right? One, because it has to balance, right? As Isaac is saying, but also think about it. Do you owe more because of having cash in your pocket, or do you owe less to that customer because you have cash in your, you owe more. You owe them the landscaping services, right? Liability up. But now, when we mow the grass, what happens to the unearned revenue liability? It's going to go down. And what's going to go up in its place? Revenue. Are we cool? Feeling this, right? Good. Equity. 4 components of equity. And we see both on the slide and on our diagram how each component of equity always affects our accounting records. So when we engage with an investor, the investor gives us cash. Cash is an asset and it's increasing, right? What do we give that investor in exchange? Ownership, right? And in our accounting terminology, that ownership is represented as common stock. Common stock is always increasing equity. As more people become owners in our business, we want to show our equity increasing. That means we have more investors out there. Are you with me? Revenues. Oh, yes, please. Good question. How can you define that? Equity is, okay, wow, I really like that question. Let's rework our accounting equation to answer your question, okay? If we take the liabilities, let's do a little algebra. We take the liabilities and move it to the other side of the equal sign. Equity represents the amount of assets that are left over after you've paid off all of your liabilities. Does that make sense? So that's one way that you can look at equity. Equity represents, here is the amount that would be left over of our assets if we liquidated everything. We turned everything into cash and we paid off all of our liabilities. This is what would be left over. That's the representation of equity, okay? But the way that when it comes to this breakdown of the accounting equation, typically refer to equity is, equity represents the amount that the investors have given you and the amount of earnings that you've retained, right? Because remember, when we create our balance sheet, the equity section of our balance sheet shows common stock and it shows our retained earnings. So when we think about it in terms of this breakdown of our accounting equation, equity represents the amount that investors have given to us, as well as the amount of earnings that we've retained over the life of our business. Like as long as we've been open, all of those earnings all accumulate as part of our equity. Does that make sense? Good question. What was I talking about? Revenue, I think. We talked about common stock, revenue. Revenue, we have performed a service for a customer, or we have provided product to a customer, we have earned revenue. Now, that doesn't always immediately come with cash, right? We already said that. We already said sometimes we can provide a service to a customer, or we can provide product to a customer, and they don't give us cash right away. So we show that as account receivable. But either way you slice it, whether you get cash immediately or whether they're going to pay you later, if you perform a service or provide a product to a customer, that's revenue, okay? Expenses. And revenue always has a positive effect on equity. It's always increasing our equity. It's always increasing our earnings, okay? Expenses. Anything that we incur, anything that we use up in order to run our business. We have to use advertising. We have to use utilities to keep the lights on. We have to use our employees, right? Anything that we use up in order to run our business, as you use something up, you report an expense. Okay, so this is where that prepaid versus expense conversation came in that I will reiterate now, right? Let's say that we get a bill for our utilities for last month. That's an expense. Let's say we get a bill for our rent for next month. That's prepaid, right? So the timing of it is really important. If you've already used up whatever it is, the utilities, the employees with their salaries, the rent, insurance coverage that you have for your facilities, if you used it up already, that's an expense and it has a negative impact on our equity. It's decreasing our overall earnings. And then lastly, dividends. Again, someone remind me what, I think Cooper said it last time. Somebody else remind me, what is a dividend? Right. We have all of this income. We're doing good. We want to share the wealth. So some of this income we are going to distribute as a cash dividend to our investors. We're giving you a little piece of the income that we've earned. Again, dividends aren't bad, but they do have a negative effect on equity. They do decrease our equity because we're taking all of the earnings that we have and we're giving some of it to our investors, right? So it has a negative impact on our equity. Are we cool on this? Assets, liabilities, equity, okay? So now, I'm going to introduce the next couple of slides, but this is where we will start on Monday. Forgot what day it was. It's Friday. This is where we will start on Monday, okay? After we have identified that a transaction has actually occurred, and we have analyzed that transaction in terms of our accounting equation, we know whether it's an asset, a liability, or part of equity. We know whether it's increasing or decreasing. After we have done that analysis, the next step in the process is to record those transactions in a journal, okay? I mentioned to you, what we used in chapter 1 was just for class. Accountants don't use that in order to record transactions. Accountants use a journal, a diary. We're going to keep a little diary of every single transaction that's happened during the month that we are covering. It's a chronological list of every transaction that happened over a given period of time. And again, a lot of times in this class, we'll be talking about a month's worth of activity, okay? So the journal that we're going to begin using on Monday is going to look like this. So in Moodle, you should see in chapter 2, here's the chapter 2 Excel spreadsheet. You don't have to open it right now. We're not going to use it right now, but Monday you're going to download that and we're going to start putting stuff in there. Okay. That journal looks like this. Notice there is a date. First of all, there's a heading so that we know what the heck this thing is. This is our general journal. It's our log. It's our diary of every transaction that we're going to have this month. Okay. Starting on the left-hand side, we're going to show the date. When did this thing happen? This transaction that we've identified and analyzed, when did it happen? We're going to list the account names in our journal, right? So are we talking about cash? Are we talking about accounts payable? Are we talking about common stock? Are we talking about equipment? What account names are we using? We're going to put in that middle column, okay? You see PR stands for, if you see in Excel, anything that has that little red triangle, if you hover over it, it gives you a little comment that I've provided. So PR stands for posting reference. In an actual accounting system, every single entry that we make into the journal will be given a number, like a transaction number. So that if you want to go back and recall that in the accounting system, you'll very easily be able to identify it. We're not going to use posting references in this class, okay? We're going to use the dates, we're going to use the account names, and then we're going to use debits and credits. So far in this class, you have only been asked 3 questions with the transaction analysis. You have been asked, what account names do you want to use? That's good, we'll put them there. Are they an asset, a liability, or one of the components of equity? And are they increasing or are they decreasing? A 4th question that you're going to be introduced to on Monday is, because you're able to answer the first 3 questions, you will be able to answer the question, is that going to be a debit on the left column or a credit on the right column of our journal? You don't know how to answer that question yet. That's what we're going to cover on Monday, right? But by answering the first 3 questions, what account is it? Where does it belong? And is it increasing or decreasing? You will be able to very quickly know whether the number, the amount, needs to go in the debit column on the left side or in the credit column on the right side, okay? So this is where we are now going to be doing our transaction analysis. That template that you used in chapter 1, you're going to use if you want to retake your quiz for chapter 1. Remember, you have 2 attempts. That is going to be the last time we use that template. From now on, we're going in the diary, baby. We're in the journal. This is where we account for our transactions. Are you with me? So the next phase of this process, once we have analyzed each transaction, is to record those transactions in a journal. That is where we will pick up on Monday, okay? Just a couple of reminders. I sent out an announcement to the class that because there was some difficulties last evening with the quiz, I have allowed everybody to take a second attempt at it, and it is due by midnight this evening. If you are comfortable with your quiz submission, you absolutely do not have to take the second attempt. One less thing for me to look at, if I'm being honest.
What?
Trace.
You said if we did.
That's Excel basics. What I'm talking about is the chapter 1 quiz that was due today. But yes, that Excel basics grade should be in there. Okay, so if you want to do a second attempt at chapter 1 quiz, which is in the chapter 1 section of Moodle, you have until midnight tonight to do that. It's still going to be timed, still going to be the same kinds of questions. So, you know, you can choose what you want to do. The other thing that you are going to do for me for this class by Monday is the chapter 2 Smart Book in Connect. So that's where you walk through different parts of the chapter. You're sort of reading through, maybe doing some practice activities to sort of get yourself familiar with the content of the chapter. That is due on Monday. Okay. Does anybody have any questions?